All right, welcome back. My name is Mark Atkinson, and this is video 2 in a 6-video series that was produced to help you, the PAC attorneys serving IDS clients. And it was created in partnership with IDS, specifically Carla Huff, and the Incubator for Legal Practice and Innovation, which I represent. So as I mentioned, it's a 6-part, 6-video series. You can see the 6 that are listed there. This specifically will be on cash flow management, video number 2. So let's jump into it. So you saw these points, these 3 points here in the first video, and I'm going to keep reiterating them throughout the series because I think they're just important fundamentals to keep in mind. The first thing is you can do well and do good. You can make a proper living in the work that you're doing. Just because you're serving indigent clients doesn't mean that you can't make enough to survive. I do fundamentally believe that there are business models out there that can sustain mission-driven law practices like yours. Second thing is stop thinking like a lawyer. You're a business owner. Whether you like it or not, you're a business owner. And treat your law firm like a business, which it is. And the third principle is your mission is more powerful if it's sustainable. You cannot serve the clients that you want to serve and fulfill your mission in your community if you're financially drowning. A strong business foundation amplifies your impact and enables you to do what you want to do. So this video will be the cash flow management will be split into 2 parts, part A, part B. The first part A will be talking about more of the concepts and some definitions. Part B will be a little more practical and talking about cash flow in the real world. So why worry about cash flow? Well, I do believe that Jesus is Lord, but in this world, cash is king. Cash is what pays your salary. Cash is what puts groceries on your table. Cash is what puts a roof over your head. And cash flow is being able to track, predict, and monitor the cash that's coming into your business and the cash that's going out of your business. At all times through the month, it's going both ways. And you want a little bit more coming in than you want going out. That's oversimplifying it, but that's what cash flow management is all about. So some important concepts that we'll be talking about and diving into deeper in this video and also in part B, but we'll talk about cash flow management, what that is, talked about the cash flow in and out, up and down through the month. It varies seasonally. Some months you'll bill more hours than other months. Some months you'll have more expenses than other months. So that's what cash flow management is. Budgeting, we all sort of have a general idea. We should have a personal budget in terms of what we spend on groceries and our housing costs and Netflix subscriptions and all those different things. And those expenses need to be less than our income. Likewise, you have a business budget to track those expenses and income as well. The third principle or concept that I'm going to talk about is revenue diversification and projecting future revenue. We'll talk about that in a minute or later in the video. And then managing expenses or managing your overhead and what that's all about. As a business owner, you have an overhead, and it's not your roof. It's those expenses that you incur each month to help you run your business, to keep your business in operation. So why worry about cash flow management? These 3 bullets basically are saying the same thing in different ways. That cash flow management enables you to withstand the economic downturns and unforeseen expenses, the ups and downs of the business world from one month to the next. It helps you manage your risks, and I don't know if it's most importantly, but it allows you to scenario plan or plan out different scenarios of what your revenue stream or income stream might be versus your expenses. And it can help you make decisions as to when you spend money based on when the income comes in. So cash flow management, if you have the right tools, gives you the ability to manage your risks, create a buffer, and plan out different scenarios in your business. Talked about this a little bit about budgeting and revenue and overhead. So why worry about budgeting? Talked about that already. As a business owner, you need to have a budget in terms of where your money's coming from and where your money's going. Money's more likely to go where you want it to go in terms of the right expense if you have a plan for where to put it. If you don't have a plan, then at the end of the month, you don't know where the money went. So revenue diversification and projection. Diversification is basically the idea of, do you have one source of income, one client, or multiple sources of revenue slash income? I use revenue and income interchangeably in this conversation. Or do you have multiple clients and multiple sources of income and revenue? Maybe you have multiple practice areas, or maybe you have specialized in one specific area where you, and that's all about diversification. There's some advantages to diversification. If you spread yourself too thin, however, diversify too much, then you're a master of nothing, and that could be an issue. So there's some wisdom in diversifying, but not diversifying too much. Projections, the idea is being able to project out into the future what your revenue is going to be. And there's different things you can monitor in terms of your marketing, your connections to clients in terms of that will turn into work, but projecting your revenue based on some of those factors and having an idea of how much revenue you're going to make 3 months from now, 6 months from now. Of course, the further you go out into the future, the fuzzier it's going to be, but having that ability to project to some degree of accuracy is helpful, particularly with cash flow management. And then with overhead, as I mentioned, the overhead are those expenses that, go my screen down there. In simplest terms, the overhead are those expenses that you incur, regular expenses that you need to keep your business running. It could be your subscription costs, your rent, your accounting fees, those things that you need to incur every month to keep running. And managing those expenses, not locking into expenses you don't need and spending money on things that you don't need, but managing your expenses and trying to be lean as much as you can. So that's a overly simplified definition of overhead. So some important terms that you'll want to know as a business owner. GL, General Ledger. The GL is a record of all your past transactions, and it's organized into different categories or accounts. And it gives you detailed information so that what did I spend $37 on? When was that, and what was that for? So there's generally 5 major GL accounts: operating expense, operating revenue, your assets, like your cash you have in the bank, and accounts receivables. We'll talk about AR, accounts receivables, in a bit. If you own a building, those are all assets. Liabilities, the 4th major GL account. Liabilities are things like if you took out a bank loan, if you owe money to a vendor, or owe money in terms of a lease payment. Those are liabilities that you have to track. The 5th category, stock, is really not relevant to a solo PLLC, but if you're part of a small company or a small corporation where there is stock among the partners or the owners, you would track that in a general ledger account as well. So that's what, when you hear an accountant or a bookkeeper talk about a GL, it's general ledger. The other important financial statement to get familiar with, is the balance sheet, and that is a snapshot of your financial health. The 3 major categories are assets, liabilities, and I'd say shareholder equity. Of course, if you're a solo PLLC, you're not a shareholder per se, but it's the equity. So your assets equal your liabilities plus your equity, or shareholder equity. Or another way of saying that would be your assets minus your liability equals your retained earnings or your equity. So it's good for snapshot information. You can compare it to previous months to detect trends. It by itself doesn't show trends. So typically a balance sheet will be as of May 31st or December 31st. So you could compare your May 31st assets to your December 31st assets and look at trends. Are your assets increasing? Are your liabilities shrinking? Is your equity increasing? So one particular report won't show it, but if you compare it to previous months or previous quarters or last year's, a year ago, it gives you helpful information on the financial health. So that's the balance sheet. A very important financial statement that a bookkeeper or an accountant can help you set up, or accounting software, is what's called a P&L. P&L, or profit and loss statement. And I know this is a small font, but basically your P&L, there's the top section, or what's over to the left, is your income, all your different sources of income from clients or from sales or whatever, however you might categorize your income. So it tells you your total income. And then the next category is your operating expenses for the month. It could be accounting fees, contributions, hardware costs, software costs, internet dues, subscriptions, insurance, education, CLEs, office supplies, whatever. So your expenses. And then the net is the net profit, or what your net profit for the month. So you have income minus expenses and what you have left over in terms of net profit. But that's a helpful report. Again, it's a snapshot. You can compare it to previous time periods. A P&L can be over a particular month, or it can be year-to-date information, and that's a helpful report to look at, the P&L report. A few more terms for you that you need to know about and keep track of, but WIP, or work in process, WIP, work in process. Again, you don't hear this one so much, but a bookkeeper or an accountant might talk about WIP, and it's helpful to know what they're talking about. Basically, WIP, or work in process, is work or effort that you've expended on work for a client but have not yet billed. Work or effort that you've expended for a client but have not yet billed to the client. The key point there is you don't want a lot of WIP. You don't want to sit on it. You want to bill it. So if you do the work, bill it. But there is a time period from when you do it to when you bill it, and that time period, that amount of money, is called WIP. Next category, next term, is AR, or accounts receivables. Accounts receivables, and this is what you have invoiced or billed the client but has not yet been paid. So what you've billed or invoiced the client but has not yet been paid. The key point there is the sooner you get paid, the better. And a truism about AR, or accounts receivable, is the older it gets, the less likely it is to be paid. So let me play this out in a scenario there in gold. So the example here is on May 1st, you do 10 hours of work for a client at $65 an hour. So that's $650 worth of work that you did for a client on May 1st. You have now created $650 of WIP. On May 30th, you bill that $650 to a client. When in the process of billing it, you have converted that WIP into an AR. So it's no longer WIP, it's now AR. So you've billed the client, it's sitting in accounts receivable. The client gets the invoice on May, say June 1st, you mail it out or you send it to them at the end of May, they get it 1st of June, they sit on it for 30 days, and then they pay it on June 30th. It hits your bank. So that $650 is now cash. It's no longer WIP, it's no longer AR, it's now cash in your bank account. So between the 30 days that it was WIP and the 30 days that it was AR, you've waited 60 days for that work to turn into cash in your bank. So the principle here is you want to minimize the time that it's in WIP and minimize the time that it's in AR. In an ideal world, you would do that work on May 1st, you'd send them the invoice that afternoon, and they would pay it that evening. But that's not the way it works. There's inevitably going to be some period of time where there's WIP and some period of time where it's AR. And your job as a business owner is to minimize that time so that you're not waiting to put that cash in the bank, because cash is king. Cash is what you pay your salary with. You don't pay your salary or you pay the rent or groceries with WIP or AR. No grocery store, no bank will honor your AR or WIP. They want to see the cash. So that's the end of part A. Take a break, walk around, and come back to part B, and we'll be talking about some more practical examples and all about cash flow management. Thanks.